Okay, let's just dive right into this explainer and completely demystify the stock market. Because look, here is the absolute truth. Building real wealth, it is not about being some Wall Street genius. You don't need a master's degree in finance, and you're for sure not going to learn the secret from a bot in the comments section trying to hustle an AI-generated ebook. We're going to look at the actual historical data and the basic math to prove that investing is actually incredibly easy once you just understand the foundational mechanics. Which brings us to a really crucial question. Is there a real difference between investing and playing roulette? Well, when it comes to gambling, we all know the old saying, right? The house always has the edge. The odds are just mathematically stacked in the casino's favor. Now, investing in stocks can actually be dangerously similar for a lot of folks. Except instead of the casino having the edge, it's massive institutions like BlackRock. One of the absolute biggest traps everyday people fall into is emotional investing. They'll funnel their entire life savings into highly volatile penny stocks. Or maybe they pour everything into some explosive tech company just because it shot up 50% in a single month. They're treating the market exactly like a roulette wheel, driven entirely by stress and hype instead of actual strategy.
And when you compare the guy who made a massive 1,000% return to the guy who completely lost everything, a negative 100% return, what's actually fascinating here is that neither of these investors is relying on actual skill or research or strategy. A lot of the time, the literally only difference between massive success and total utter ruin in this scenario is simply which four-letter stock acronym they decided to blindly gamble on. The guy on the left might look like a total financial guru to his friends, but honestly, it's pure luck.
To really put that kind of luck into perspective, let's think about the number 2.63%. Going back to our roulette analogy, imagine you walk right up to a table and drop 10 grand on green. You literally only have a 2.63% chance of winning. But let's say the ball actually does land on green, and boom, you walk away with a massive $350,000 payout. Does winning that money magically make you a highly skilled gambler? No way. You just happen to pick the one color it landed on. And it absolutely doesn't mean you should start teaching other people how to play roulette, right? Well, the exact same logic applies to picking lucky stocks. Now, of course, even if you're smart enough to avoid gambling, you still might be sitting on the sidelines just because of general economic anxiety. And hey, it's totally normal. Maybe you're having nightmares about a looming AI bubble popping, or perhaps you're terrified of some hypothetical 2027 global recession triggered by, I don't know, an unflushed urinal at the NVIDIA headquarters. People can always find a highly creative reason to be terrified of the market. But letting those anxieties keep you completely out of investing, that actually exposes you to a much more dangerous, absolutely guaranteed threat.
And that guaranteed threat is hiding right inside a $50 bill. Because of inflation, which is guaranteed by the way, your money is losing roughly 2 to 3% of its purchasing power every single year. Inflation isn't just some economic theory, it is a permanent feature of our economy. If you just leave your cash sitting in a bank account earning a 0% return, it's actively shrinking. To put that into real, everyday terms, by the year 2077, assuming the chain still exists, a single Chipotle burrito is guaranteed to cost you $50 or more. Let that sink in.
So, to outpace that burrito inflation, you'll have to put your money to work. Keeping it in cash gives you a big fat 0% return. That's a guaranteed loss of purchasing power over time. Now, moving one step up the risk ladder, lending your money to the government or corporations through bonds involves a little more risk, but you're compensated for that with a highly reliable 4 to 7% return. But the true sweet spot for long-term growth, that is the U.S. stock market. Historically, we're talking about an 8 to 10% return over the long term. Even the more conservative current projections sit right around 8 to 9%. It is literally the mathematically necessary vehicle for building long-term wealth. So the absolutely crucial point here is that we aren't out here looking for the best lucky investment. Sure, yeah, you could have bought Dogecoin back in 2020 and made an absolutely absurd 35,000% return. But the chances of actually predicting that are basically zero. Instead, what we want is the optimal investment. By definition, an optimal investment is a predictable way to get a high expected return for a relatively low amount of risk. It's not based on your gut feelings or some random Reddit post. It's based entirely on hard historical data and proven mathematical models. Which brings us to another super vital concept, and that is expected return. Now, a lot of people mistakenly think broad index funds are these totally risk-free, ultra-safe little vehicles designed for like librarians who sip chamomile tea and play board games on a Friday night. But that's a total myth. Index funds absolutely carry risk. The market goes up and the market goes down. But here's the thing, risk isn't inherently bad. In the stock market, taking on this specific type of calculated risk is mathematically worth it because it appropriately increases your potential payout over time.
To really wrap our heads around exactly how expected return works across time, imagine a massive number, 14,605. If you were to simulate an investment with a 5% expected return across 14,605 parallel universes, you wouldn't get exactly 5% every single time, right? Sometimes it'd be higher, sometimes it'd be lower. But the mathematical average return across all of those parallel universes combined would equal exactly 5%. That is the sheer power of expected return. You are playing the mathematical averages over a very long time horizon.
So who exactly do we have to thank for making this mathematical powerhouse available to everyday people? Meet John C. Bogle. He's the founder of Vanguard, and frankly, he is an absolute legend in the financial world. The guy practically invented the modern index fund. He structured his company to give the profits back to the actual shareholders, and it's estimated he saved everyday investors about $1 trillion in fees over the decades. $1 trillion! And what's really incredible is that because he didn't hoard all those profits for himself, his personal net worth ended up around $80 million, which is actually lower than Barbara Corcoran from Shark Tank. He quite literally sacrificed his own billionaire status just to give the rest of us the ultimate optimal investment tool.
And Bogle's legacy gives us this incredibly simple, mathematically optimized strategy known as the passive three-fund portfolio. Think of this as your ultimate, completely predictable shield against bad financial weather. It consists of just three simple things: a U.S. total market index fund, an international total market index fund, and a bond index fund. That's literally it. By holding just these three funds, you own a piece of essentially every single profitable company on planet Earth, and it's all nicely balanced out by the safety of bonds. You don't need to stress about picking the winning horse. You're just buying the entire racetrack.
Now, to understand how these total market index funds actually do their magic behind the scenes, we have to talk about market cap. Market cap is simply the share price of a company multiplied by the number of available shares. In theory, it's exactly what it would cost you to just buy the company outright, 100% for yourself. Total market index funds, like Vanguard's VTI, for example, which holds over 3,500 different U.S. stocks, they distribute your money automatically based on this market cap. Let's see how that actually looks in practice if you were to drop a $10,000 investment into a fund like VTI. Because it's weighted by market cap, the fund automatically funnels the most money into the biggest, most successful winners. So out of your 10 grand, $713 goes straight to NVIDIA, $612 goes to Apple, $587 to Microsoft, and $350 to Amazon. On the flip side, massive global corporations like Starbucks and T-Mobile, they only get about $14 each. The fund just naturally balances itself, backing the absolute heavyweights of the economy without you having to lift a single finger or read a boring earnings report.
Now, you might look at that breakdown and think, that feels way too heavily concentrated in a few big tech companies, which might lead you to hunt for other exchange-traded funds, or ETFs. You'll see thematic ETFs, sector-specific ones, actively managed funds that promise they can beat the market, or even those wild quadruple-leveraged Bitcoin ETFs. And while some of them can add a bit of diversification, a lot of them are highly questionable. Here is the real danger. When the market inevitably takes a nasty downturn, and it will, it is far, far easier to panic sell an active, questionable ETF that you don't fully understand compared to holding on to a total market index fund that has literally decades of proven mathematical history backing it up.
Because honestly, if you try to outsmart the system, you're more than likely going to fall right into this classic three-step trap. Step 1, you YOLO all your money into a single big tech stock or whatever the hottest trend is on social media. Step 2, you actually get lucky, and you beat the total market index for one single year. Step 3, the completely impossible part. You try to replicate that consecutive stock-picking luck for 40 years in a row. It is virtually impossible. People who try to actively beat the market usually end up losing everything, and then, tragically, they borrow money to try and make back what they lost, only to lose all of that too. Which brings us to our final thought for this explainer, and I absolutely love this quote. You don't want to be a day trader, you want to be the person who makes day traders mad. The data just shows it time and time again. Passive investors, the folks who literally just buy total market funds, conveniently forget the passwords to their brokerage accounts, and let the math do the heavy lifting, they consistently outperform 99% of those stressed out day traders who treat the stock market like it's a grueling full-time job. The math is clear, the strategy is incredibly simple, and the historical data is entirely on your side. So as we wrap this up, I want to leave you with this one question. Are you going to keep treating your financial future like a random spin at the roulette wheel, or are you finally ready to let the mathematical average build your empire while you sleep?